Anthony, many thanks for making time to speak to us. Let's just start with just a brief basic. The earnings per share 98% up, EBITDA also up close to 5%. Walk us through what I have not mentioned, of course.
Yeah, look, I mean, our adjusted headline earnings, which we think is the true measure of our performance, was up 4%. I think it's been a very difficult trading environment, and I think we've done, I won't say well, but I think it's a credible performance. Given the trading environment, given the consumer under pressure, our comparable revenue growth was up 1%, and we managed to keep EBITDA only down 1%, and that's including 44 million extra charge from the VAT increase, which hits casino companies straight to the bottom line.
Anthony, specifically on the debt, I think the investment community out there has been focusing on Sun's debt for quite some time now. You did a rights issue not so long ago, to bring the debt down from 11 to about 9 billion. But just looking at the income statement, the impact of that debt is that interest is growing at 14% in an environment where your operating profit is growing at 5%. And this is not specific to Sun International. A lot of South African and even international companies find themselves, trying to grapple with debt. Can you give us a sense of what the long-term strategy is to try and deal with those debt levels? Will you be considering maybe asset sales? Are you hoping that trading improves and cash flows improve to the extent that you can start paying down that debt? How do you intend dealing with this problem of high levels of debt for the longer term?
Yeah, look, in South Africa, if you look, you've got to split our business up into two, LATAM and South Africa. Now, if you look at South Africa, our interest actually increased this year. And a bit of an anomaly in that last year we were capitalizing a lot relating to the Times Square Arena and the hotel. So a significant capitalization of interest that went into the asset. So this year, effectively, we start in the year with sort of 2.2 billion less debt, and we will see our interest charge come down quite significantly. In South Africa, we're sitting at about a 3 times debt to EBITDA, which is obviously the investment community is very focused on. We were getting close to 4 last year. We're very comfortable that we'll continue to de-gear, that operating cash flows, which were quite strong last year, 600 million in South Africa. This year, with the lower debt, we'll reduce the interest charge, and we should be reducing debt by a further 700 to R1 billion. And that also depends on a couple of smaller asset sales, and these are more some excess properties that we've got and some other things. We're not looking at a wholesale asset sale in South Africa at all. So largely, we're looking after our assets better, and we're going to continue reducing debt. I think debt is under control. We are seeing our debt coming down, and we're certainly going to focus to try and get below that 2.5 to 2 times debt to EBITDA. Our LATAM, on the other hand, has increased its debt levels following the acquisition of the fund's shares in Sun Dreams, as well as the 2 acquisitions. Debt rates there, we're sitting at just over 5% cost of debt, so significantly low and can handle high gearing. Having said that, we will also be reducing that debt down, and we are considering an IPO of that business at some point in time. And if we do that, debt will be significantly reduced and actually have capacity to expand further.
Right, Anthony, I was actually going to ask you about that LATAM bond, that's the 10-year, but you've actually alluded to that. Let's just touch some of, if we were to break down the group's income, it's quite interesting. South Africa alone, 69%, Latin America, close to 30%, Nigeria, 1%. When do you pull the plug, if I could just put it bluntly?
Well, as soon as we can. I think, there is this investigation going on, and our partners were disputing, fighting each other, and we've sort of been caught a bit in the middle. So there is an investigation going on, just checking everything. We've had ours tested every single way. We're very comfortable that will be resolved shortly. It's been ongoing for quite a while. So once that's resolved, we will certainly look to exit Nigeria almost immediately. We will realize some value. Certainly, we spent quite a bit there, but we will get some recovery. Our property still is in the top destination on Victoria Island in the central part of Lagos. So it is a valuable property, but Nigeria is a difficult place at the moment.
Anthony, we've been looking at some wonderful aerial shots of Sun City, the Palace of the Lost City, which is, I think there's no resort in South Africa that's even a close second, and it's just absolutely amazing. But you impaired that asset by 300 million in these financials. Could you give us maybe a little bit of background on how trading is taking place at Sun City, and what your reasoning on the impairment was?
Yeah, well, you'll recall a few years ago we put over R1 billion into Sun City, doing the conference center, the vacation club, the cabanas, the hotel at the Soho Hotel, the casino. So we spent quite a lot of money on Sun City. I think trading in the first year picked up quite nicely, and last year came under a bit of pressure. And really, the main driver is, I think, the South African economy. International business has dried up a little, particularly from China and India with the visas a few years ago being imposed. So the property's under a bit of pressure. The local spend on gambling as well, particularly around Rustenburg, where there's been EBTs, have hurt Sun City. So I think, it's a bit of a combination of factors. Sun City's dependent on a lot of markets. It's on leisure, it's on conference, it's on gaming, and it needs and at the moment we've just got a perfect storm where none of those are performing. So we are a little reliant on the economy picking up, like I think most businesses in South Africa. But given the cost structure of Sun City and the cost of keeping an asset like that still sustainable and still in a state where people want to come, it is really very, very expensive. So getting that right and getting that combination of a high cost base and a low margin business makes it very difficult. And when we lose a bit of revenue, that margin gets squeezed, and then the auditors say, well, hang on a second, is this a sign of impairment? Will this property, is it worth the value in the books? And nowadays they're getting very strict because of all the scouting scandals that have been around the world. Fortunately, we're not part of that. But certainly fixing that situation is pretty key. And actually impairing the asset, putting it down to the realizable value, or what we perceive to be the realizable value. If we get a turn in the economy, if we get international visitations, I certainly can see Sun City reversing that impairment in the near future. We still feel strongly that Sun City is a potentially growth opportunity. A lot of our casinos are dependent on very much the local economy, and they've already penetrated the economy. They don't have the ability to expand. They don't have more occupancy. They don't have more other businesses, where Sun City has got more potential. And I think getting that right, getting hopefully international business back, that will be what really turns Sun City around. And we're going to work hard and try and achieve that. We're not going to put more cash in than it's making, but we've got to manage it. We've got to keep it at a standard, and it really just is a very tough asset.